What's up, YouTube fam? Welcome back to the channel. In this episode, I decided to have ChatGPT make an option selling course. Now, since I wanted to be nice, I'm not going to read it from ChatGPT. I decided to actually put it all in a PowerPoint presentation. So, with that being said, let's get this out of here. Option selling course, mastering profitable strategies. I'm going to try to keep it short, simple, sweet, and to the point so that everyone can follow me. Of course, if you're a beginner and you want to learn more, make sure to subscribe to the channel. Make sure to join the Discord so you can communicate with myself and other professional option sellers. So with that being said, let's get into it. So slide one, introduction to options, right? What are options? Options are financial derivatives. There's two main types, calls and puts, right? Typically, if you buy a call, you expect the market to go up, and if you buy a put, you expect it to go down. The use is for hedging, speculation, and income generation, and that's what we're here to mostly talk about is income generation. Slide number two is buying versus selling options. So a lot of people always get this too confused, right? Option buying is you pay the premium. Option selling is you collect the premium. Option buying is the premium that you pay is all that you're risking. Option selling, you're risking the entire amount of shares, right? So let's just get into the option chain so you guys can see what I'm talking about, right? So if we were to hypothetically buy, let's just say calls on Connell that expire this upcoming week, you're only risking $210, right? Now, if you go to click sell the calls, you're making $210, but you're risking the fact that you have to buy 100 shares first. So it's at $40.15. You have to put up $4,000 worth of capital to collect the 210. Again, buying is the exact opposite. You are putting up the 210 to eventually have the right but not obligation to buy it back at 41. So notice how your break even is 43.10. It's because you're basically paying 210 and you have the ability to buy at 41. So if you do the math, 41 plus 210 is 43.10. So basically, if at expiration it's at 44, 45, 46, you will make a profit, right? That's how buying options works, right? Back to selling options, you're putting up the money, but you have a higher probability of winning. So that's where delta comes in. In this case, delta is 46. So that means that is a 46% chance that this will expire in the money. And if you go to click sell call, you'll see how it says 71% chance of profit. That's because it's saying there's a 71% chance that it's either going to expire under 41, or if it's over 41, it'll be under 43. So that's how the chance of profit works, right? I'm trying to keep it, again, as short and simple. But if you're a beginner, some of this might sound confusing. It might sound like I'm going fast. So I already apologize. This is a course, right? It's for people who want to master A to Z. But, time. That's the thing about selling options or buying options, right? You're always battling time. In life, you're always battling time. But the main point to understand the difference between buying versus selling is time decay. So when you go and you look at something like theta, right, you see how every day this option is going to lose $2.10. If you're a buyer, that's not good because you're buying at $2.35. So if tomorrow or Monday or Tuesday when the market opens, it's at $2.10, you're not happy. As a seller, you are happy, right? Because if you sell and you're collecting the $2.35 of premium, this 21 cents is going to be profit. So if you're going to collect 230, now you're already up 20. You can close the position and take the 20. Or, of course, you can wait it and let this premium soak and lose money, unless, of course, Connell was to continue going up. So that's a very simple explanation of the difference between selling and buying. Let's go to slide number 3. So understanding option pricing, right? And I kind of got into it in the last slide, but ultimately delta is basically how much the option is moving, but it also tells you, which is how option sellers look at it, what the percentage of you being profitable, or better yet, it being in the money or out of the money. So notice how when you pick a strike that's lower, the delta is higher. Why? Because there's a higher chance that it will expire in the money. And if you go higher, right, there's a higher chance that it expires out of the money. So in this case, I sold the 47 covered call. Why? Because I anticipate that it would expire below 47. And so in that case, I will collect the premium while keeping my shares. Now, it is a little different because I have these 200 shares of Connell that I purchased, as you guys can see, at $45.81. I've already collected $100 worth of premium selling covered calls. It could have been 200, but regardless, so in this case, I'm not down 1,100. I'm down 1,031. And obviously, that's the cool part about covered calls is you can continue to make back losses while waiting for it to return towards your entry price. And in a lot of ways, you can actually make back everything you lose and then some, and then ultimately get out for profit. So obviously in this case, I've only sold one covered call. I have 200 shares. I'm trying to wait for the market to go up before I sell covered calls. Why? Because if I sell covered calls now, and obviously in this case, right, it does look like Bitcoin is going up a little bit on a weekend. Who's to say where ConL is going to open on Tuesday? So if I was, obviously, first of all, in options, you can't even sell them on weekends, right? But if I was to sell covered calls before it goes up, then the problem is that those calls will gain value, which will make it harder for me to exit. So if I wait for it to go up and then sell covered calls as a way to take profit, in my opinion, that's a better way to go about it. So delta is the one that we look at. We look at theta as well. Vega and gamma, I know some people look at it, I really don't. But ultimately, theta is how much the option is going to lose every day, which as an option seller, you will gain that profit. And delta tells you the percent. So theta is exactly, we look at it as a way to see how much we're going to profit each day as an option seller. So of course, the beautiful part about selling options is if the price doesn't move, right, if it stays in a range, then you will collect theta, and ultimately, as long as it's out of the money, it will expire worthless and you will collect all that profit. Obviously, as an option buyer, that is what makes it so much more difficult to win in this game. So why sell options, right? There's a high probability of success, 80% win rate. Now, obviously, that will depend on the strikes you choose. So in this case, I have sold a put on TQQQ. And at the moment, as you can see, let's just look at the position, right? At the moment, you can see they're giving me a 70% chance that this is going to expire out of the money, which means there's a 70% chance I will collect this $100 and not have to get assigned on the shares. Now, when I did open this position, it was, more towards the 68%, right? But since it's gone up, video's freaking cursed. Since it's gone up, it has gone more in my favor, and the premium has lost value, which is why I'm already in the profit on this position. So obviously, when it comes to selling options, it's a great way to generate consistent income, benefit from time decay, right? Because Father Time always wins, and it works well in a neutral to slow moving market, which, listen, it works well in fast markets too, because if you're selling covered calls, you can roll them up. And if you're selling cash secured puts, you will profit when it goes up. And obviously, if it goes down, you can roll down. Rolling is not, we're not gonna have time to discuss rolling in this video. If you want, search rolling in my channel. There's plenty of videos where I've rolled options, and I will definitely continue to roll. So make sure to subscribe if you want to learn more about rolling or just learn what I'm talking about. So slide 5, potential popular option selling strategies. Now they did list more, but I'm going to stick to the ones that I'm doing, right? So covered calls, selling calls against own stock for passive income. So it's beautiful because we have covered calls open. So we'll talk more about ConL. So right now, again, we have these shares at 45.80. We sold a covered call at 47. Let's see, does it show our last position? So here, we sold a covered call at 47. No, sorry. Let's see. Is it not? So it doesn't want to show the history from, when we sold the covered call. It's only showing us buying it back. So we sold the covered call at 100, and we sold 2 of them, right? And we bought each one back 45 and 55. So it was like we sold it for 200, bought back for what, 110, collected $100 in profit. Right? How does that work? It worked because ConL went down. So if we pull up the ConL chart, what you'll see is when we sold the covered call, it was like around here, right? It was like 45.85, right? When we got into the position. So when we sold the covered call, it was up here. And of course it came down, and that's why we profited. So the beautiful part about selling covered calls is that when you're in shares, the covered calls will become profitable when the market begins to fall. Obviously, if it goes up, then you will either have to sell your shares at the price of the covered call. So in this case, right, I sold a $47 call. So you see ConL is currently at 40.14. If by this upcoming Friday, ConL is above 47, so above this price, I will have to sell my shares at 47. Or what I can do is roll, which I know I said I wasn't going to roll in this video or talk about it, but I'll show you real quick. So let's just say hypothetically, ConL is above 47. Instead of me selling, right, what I can do is roll to a later date and a higher expiration, which will buy me money and time. So if we go and let's see if we can actually roll or click the roll button just to show you. So I always like to roll for a credit, right? Because why would you want to lose money? So in this case, right, our covered call is worth 73 cents. So hypothetically, if it got above 47, which again, this would go up in value at that point, so it wouldn't be this easy. But this is just a hypothetical. We can roll all the way up to 75. Again, it's not going to be this. You're not going to be able to roll this high up. But let's just be realistic. We could probably roll to 65. So what makes that amazing is now, instead of having to sell my shares at 47, I can have the position, or better yet, the right but not obligation to sell at 65, assuming, it does expire above 65 by this date of March 21st. So that's how rolling works. Essentially, rolling is buying time, which allows you to keep your shares and gain and take on more capital gains, as opposed to having to sell at 47. Because as much as collecting premium is awesome, let's be real, right? This is $73 that I'm anticipating to collect, and we're talking 200 shares of Connell, right? So you do the math, let's just say 10, if Connell went up an extra 10 bucks, right? Right now Connell's at 40. From 40 to 50, I would be up 2,000, or I guess since I'm already down 1,000, I'd be up 1,000. So in the end of the day, the 70 bucks, the 100 bucks, the 200 bucks worth of premium is really just crumbs when you're talking about the shares, which is why you would want to roll up, because you would want to keep your shares. So that's how rolling works with covered calls. That's how covered calls work. Cash secured puts, this is my favorite strategy. This is, in my opinion, the #1 way to generate income. Now, why is that? Well, first of all, it obviously depends on which asset you're choosing. So TQQQ is my asset of choice. If I was to, want to die for selling cash secured puts on one asset, it would be QQQQ. Now, why is selling cash secured puts the best way to create income? Well, one, it's because when you pick an asset like NASDAQ, SPY, QQQQ, you're picking an asset that goes up, right? It doesn't always go up, but for the most part, it goes up. Two, you're not shorting it, you're shorting the puts, right? So what does that mean? It means you are, or better yet, here's another term, you're fading the puts, right? You are betting that people who sell puts, people that buy puts are going to lose. That's what happens. When you sell a put, you're saying, I think that people who buy puts are going to lose, right? And I can tell you this, that traditionally speaking, in the market, people who buy puts do lose. Now, obviously, yes, there's these spurts of the market dumping, of course. But when you zoom out at the highest time frame, for the most part, this is not something you would want to be buying puts on, right? Why? Because when you buy a put, you are battling against time, and you're battling on it to go down. So even if it does go down, right? Like, let's just say a moment like this where it's dumping and then it shoots up. Assuming you were rolling lower and lower and lower, okay, this couple months would be a rough couple months, but when it has this spike, those puts would lose value so fast that you would be able to still be profitable, even in a downtrend. And then, of course, this, all right, would be a little annoying, but again, comes back up. And then at this point, we're trending again. And you see this, it's, this is what I like to call a barcode, right? Because it's like when you look at it, it's scanning up and down like a barcode. Excuse my terrible drawing. This is where option sellers profit. Yes, there's some big moves in between, but for the most part, first of all, we're selling out of the money options for a reason. Second of all, this is just, in the end of the day, right, I feel as if the way the markets move is it's trying to screw over option buyers, because option buyers have the potential to get rich the quickest, and the world just doesn't work like that, right? The world is a world of consistency and compounding, and when you start to pay attention, you realize that a lot of the movements are to scare people out of their positions, and when you're selling options on assets that you can trust, there's nothing to ever be afraid of. Right? So you just collect premium, move on, and take the next play and just win over and over again, which I've been winning a lot selling TQQQ puts. Obviously, in this case, I'm only selling one contract, right? And it's costing me $8,700 worth of collateral. So let's just do like a little fun experiment, right? Because I've been discussing putting a lot more money into this account. Hypothetically, if I was to, so obviously if I wasn't in this position, I would sell something a little closer to the money, just because it's TQQQ, so it would be one of these two. So then if I was to do it one more time, right, it would be 8,700 again worth of collateral to collect 132. So obviously, if we were to add, let's just say a 0, and we had 87,000, it would be 1,300 for the week. Now, obviously that can generate some great income, 1,300 a week. So you're talking 2,600 every 2 weeks, 5,000 roughly every month. Now, of course, there's times where premiums are more inflated, premiums are deflated. Also, what's very cool is you don't have to wait the 6 days. So let's just say Monday morning, TQQQ starts rallying. The cool part is ultimately you will be able to cash out a lot of this put early. You might be able to make 500-600 by Monday and then reopen a closer to the money put. Obviously, there's also people who really have, I guess you could say more kahunas than I do, where they might sell something in the money. And in this case, you would be collecting $180 per contract. So again, if we add a 0, you're talking $1,800. And again, if it does open, let's just say up at 91, 92, you might be up 50% of this within the first day. So instead of waiting 1800 instead of waiting a week for 1800, you just made 900 in one day, and then you reopen a new position, either higher or lower, depending on your risk tolerance. So selling cash secured puts, in my opinion, especially on something like TQQQ, SPXL, these are the best assets. Now, obviously, yes, I'm not going to be ignorant to the fact they are leveraged, right? And you will get more safety out of SPY or QQQQ. But it's also being realistic that the average person doesn't have 53,000 or 60,000 laying around, and that doesn't mean you shouldn't be able to take part in the fun, right? So that's why we have things like TQQQ, UPro, and even if I could afford, one contract for SPY, I think I'd still rather do multiple for these other assets. It just pays better. The premiums pay better. Of course, you're going to get more volatility in the down market, but over the long run, you're going to be collecting a lot more premiums. So those are the two main strategies. Now, the last strategy that I like to do is the poor man's covered call. So we'll show you guys a real example. And it's great that I have, a position open for every single, example. So a poor man's covered call is the same thing as a covered call, but instead of you buying shares and selling calls, you're buying a deep in the money option. So in this case, as you can see, it expires in 2027 and it's a $65 strike. Now, a lot of people say, oh, this is crazy. You're buying deep leaps on, leveraged assets. Well, first of all, obviously we're already up good money on the position. Second of all, I would still rather buy a leap on a leveraged QQQQ than half of the assets that people are investing in today. So yes, we are doing that. And obviously in the world that it does turn bearish, that's why we're selling covered calls. So in this case, the covered call that I sold is getting destroyed, right? It's deep underwater. So with poor man's covered call, since I don't have the shares, right, the last thing I want to do is relinquish the position because, it's just not what you're looking to do. So what we will do is we will roll. So with that being said, right now we have the 87.50, as you can see, sold for this week. And depending what happens this upcoming week, we will just roll it higher into a later date. So at this moment, as you can see, I can roll it an extra week out and get it from 87.50 to 89.50 and still collect a credit. Obviously, if I want, I can go even higher and pay a debit. But again, I like to roll as high or low as I possibly can while still collecting credit and not losing money. But with that being said, I typically don't ever roll until it's the day of expiration, because if this week happens to be bearish, right, then Tuesday, Wednesday, Thursday, this premium is going to get killed. So instead of being down money, it will be up money, right? Again, how are you down? Well, I'm down because when I opened this position, I opened it for 144 credit, and now that credit is worth 340. So, it really isn't about the fact that I was bullish or bearish. It's really just that you're buying a deep leap and then you're collecting premium on that leap. And if you're losing, then you're rolling higher so that the leap keeps gaining value. And then eventually, listen, if you keep rolling higher, eventually there is going to be these downturns where your covered call will expire worthless, and then you'll collect all that, right? So, if you're rolling and you're collecting credit, you're kind of building this snowball, right? Because at this point, yes, I'm in this $200 hole, but assuming I roll and collect a credit, then it'll be 300, 400, 500 worth of premium, right? Because think about it, right now it's worth 340. If I roll to something higher, 348, $8 credit. So yes, there's $348 worth of premium that I'm hoping to collect. And then when you get this downtrend, right, it's kind of awesome because now instead of me continuing rolling and building this snowball, I'll finally have a chance to just collect the full premium and close out the covered call, or better yet, reset, as opposed to just continuing having the leap go up in value and continuing to roll, which both are fine with me, right? I'm not complaining either way. And of course, on top of that, we have cash secured puts that as the market's going up, they will be making you money on as well, which is why it's my favorite strategy, because I love doing cash secured puts on TQQQ while having leaps and then selling covered calls against those leaps. Now, with that being said, if I was managing a $100,000 portfolio, I'd want 80% of it to be cash secured puts and maybe, the extra 10 to 20% to be leaps. I wouldn't want my portfolio to be majority leaps because that's just too risky. Cash secured puts allows you to continue rolling lower and get a better entry price, right? So obviously, the way this put would work is if it expired in the money at 87.50, I would have to buy it at 87.50. But what makes it awesome is I can roll the same way I can roll the covered call up. I can roll this down, and in this case, right, I can roll it all the way down to 83. So instead of buying at 87.50, I'm now buying at 83. Instead of my break even being, whatever that would be, it's now $81. So, in a bear market, cash secured puts will allow you to have so much more protection than buying leaps, which is why, it's not about being greedy, guys, right? Like I showed you, $80,000 with TQQQ can produce 6K a month. Obviously, it could produce even more depending on the conditions. But the point is, yes, there's always ways to make way more money, but there's also ways to lose more. You have to have that combination of wanting to make more while protecting your current capital. Otherwise, you will never grow accounts to large amounts. So those are the strategies. So slide 6 is the wheel strategy, which is when you put it all together, right? You sell the cash secured put, right? So obviously I showed you guys that if I expired in the money, I would want to roll it. But of course, maybe you don't want to roll it. Maybe you just want to take on the shares, in which case you take on the shares and then you sell the covered calls and you repeat it exactly like a wheel. And of course, it works well on high liquidity stocks and ETFs. So you wouldn't want to do it on something like RGTI, which, that's a big mistake I made. I'll show you guys the RGTI chart, right? So I tried to sell cash secured puts all the way up here. I still have the line drawn out, and then this happened. Now, of course, if I would have held, I would have recouped a lot of the money, but I panicked because I didn't know enough about the company. It doesn't really make money. It was speculative. There was really no reason to hold, so I took the loss. Now, did I sell at the bottom, and was it the worst possible? Yes. That shouldn't have happened. I should have handled it a little bit more professionally and understood that a pullback would have to naturally happen, right? Because the short sellers would have to buy back. But I panicked. I didn't want any more of it. I got out. I let the emotions get to me. We all have those moments, right? And that's that. So with that being said, what did I take from it? I took from it sticking to companies I trust, which is why we love the earning strategy. So if you want, watch all my videos from the last week. I've been selling options on good stocks during earnings because at least if the earnings report sends the stock down, I don't have to worry as much. Where if you're trading stocks that you know nothing about that are 100% speculative, that's how you can easily panic and make terrible decisions like I did. So slide number 7, this is very important, risk management. So I'm not the best at this, and I'll be the first to admit it, right? Like generally speaking, this Connell 200 shares, it's a little bit much of this account size, right, of $8,000. Now, obviously, since we're option sellers, we do have to move in increments of 100. So I would have only been able to do 100 or 200. I couldn't have done less. But I don't necessarily trade this account like as if 20,000 was all my money, right? If it was all of my money, I would not be taking some of these positions. I would 100%, if anything, be sticking to TQQQ, which again, even 8,700 is a large amount, but it's an ETF, right? So you're not fully in an individual stock, especially a 2x leveraged version of an individual stock. So with that being said, I would try to keep everything to 10 to 20% of my account size per position. Obviously, even less, depending how big your account is, right? If you're in $200,000, $300,000, which I would say 6 figures is a standard portfolio for option sellers. 20,000 is, a small account. I know in option buying, 20, 30,000 is probably standard, and maybe 2,000 is a small account. But in the world of option selling, you kind of have to 10x it because someone has to put up the collateral for those 100 shares, right? So I would definitely keep the position sizes a smaller percent than what you see me do on my channel. I don't treat 20K like it's all of my portfolio. I treat it like it's 10% of my portfolio, maybe even a little bit less. And ultimately, stop losses are very tough to set. I know people like to do, maybe if they collect $400 credit, they like to make a stop loss 3 or 4 times that. So maybe it'll be like a $2,000 stop loss. To me, I don't see the need for stop losses because if you're selling options on assets that you would want to buy anyway, then you're not going to really have to have a stop loss, right? Because if it's a stock you would have always wanted to hold, then even if it continues to go down, you could either keep rolling the put lower so that you eventually get a better entry, or if you have the shares, you can keep selling covered calls to collect income against the bear market. So, a stop loss maybe if you're going to be selling options on assets that you don't want to hold, but as long as you want to hold it, I don't see a reason to really have stop losses. Truthfully, option selling gives you a way to dollar cost average without having to put more money in. So think about it like that. You want to sell options on assets, you would want to dollar cost average and continue being a buyer. Obviously, manage assignment risk properly. We basically have discussed adjust trades by rolling options. We've discussed monitor market volatility and earnings reports. That just goes without say, right? I like to use Econoday and Forex Factory to know when the big reports are happening, right? So obviously this upcoming week, we had Jerome Powell speaking twice. Anything with a red star is going to be very important. Just stuff to be paying attention to. And of course, earnings. We use Earnings Hub to always be on top of which stocks are having earnings. So that's how I knew this upcoming week that I was going to trade Shopify, Lyft, DoorDash, Reddit, everything we talked about all week. That's how we knew. And of course, this is probably the most important part of selling options, which again is making sure you're doing it on the right assets. So TQQQ, just quality stocks, right? Understanding what a quality stock is. It doesn't have to be, I'm not sitting here and saying you have to know everything about the company, but looking at the earnings report, right? Looking at the revenue, seeing that it's growing, that's at the very least, right? If it's a household name, even if it's a household name, that doesn't always make it a good stock, right? What's it like? Here's a good example. If we look at CVS, this would be considered a household name, but notice how if you look at the chart from 2015, it's down 50-60%, right? So it's like, even if it's a household name, does that make it a good investment? I wouldn't want to be down 50% over the last 10 years. So how can we really know? I mean, obviously the revenue, it is relatively increasing, but I think it just comes down to innovation as well. If a company isn't innovating, then they're probably not going to be a great investment. And truthfully, in a way, you don't know, right? This is the type of stuff that makes the market so tricky, right? Is like sometimes a company like this you would assume is growing, right? Wayfair, a company that you would assume is growing, but when you look at the chart, it's just not reflecting that. Obviously Walmart is growing, right? And the chart reflects it. Amazon, Google, these tech stocks are growing. So, make sure the revenue is increasing, make sure the chart is reflecting it. But again, if you want to be in an asset like Amazon where, something like this isn't really going to scare you, truthfully, if this is happening with Amazon, it's probably happening in majority of the assets, which is, I would say that one of the number one things to consider is like the relative strength versus relative weakness, right? Is your asset going down while the rest of the market's going up? That's a very important question to ask yourself. But ultimately, this is why majority of my money would be in a TQQQ or an SPXL, because yeah, there's going to be times where it doesn't make sense why a stock isn't going up while the rest of the market does. And the only way to really, guarantee that your portfolio isn't suffering is to be diversified into assets like this, which is why, again, I would prefer a 3x version of the S&P than trying to pick which stocks are going to go up and go down. So with all that being said, that's why I think the asset you choose is the most important. Obviously, I still do play around with individual stocks, especially during earnings, but it's stocks I trust, stocks that I genuinely want to be a part of, and I'm willing to lose some money for. But with that being said, you should never be putting your entire portfolio into an individual stock. Obviously diversification is very important, and that's why it's like, at least, even if all my money, right, if I had 100K and I was using all of it to trade TQQQ options, there's nothing wrong with that, because TQQQ is diversifying amongst the top 100 tech companies. So it's like, it is diversification and a safe way while still collecting high premiums due to the leverage. So that brings us to the last slide. Now we skipped 4 of them because they didn't really apply to the stuff I do on my channel. So what are the next steps? Obviously, I can tell you, load up your brokerage account, right? If you don't already have it. You can't really necessarily paper trade with option selling, at least not to my knowledge. But obviously, if you are someone who wants to option sell, like something like option selling is not someone who just discovered the stock market, right? To my experience, option sellers are usually people who have invested for a while, maybe traded, have some sort of experience in the markets. I don't think you just stub your toe and find your way into option selling. So, follow a structured plan. Make sure you're choosing stocks that you genuinely trust. Consider mentorship. Listen, I don't sell a mentorship at the moment, but you can join our Discord. The link is in the description. So please feel free. Ask me anything. Ask anything in the Discord. We have people that are always active. I'm always active. So join our community. Subscribe to my channel. I'm always going over my positions every single day, basically, or every week. I'm always taking plays, explaining the plays, showing you the plays. So take some time. I'll be honest. I've been investing in trading for years, but I did study other option sellers for months before I finally sold an option, and I would recommend you do the same. So if you learned a lot from this mini course, make sure to give it a like, make sure to comment what you thought, what you learned, what you appreciated about it. Make sure to subscribe to see where I take this account, what I do with my option selling. I have some great ideas for new challenges coming up soon, and I can't wait to share it with all of you. I hope you're having a great weekend, and I will see you guys in the next video.